Welcome to Risk Rating 2.0, Equity in Action. During today's session, we are going to define the NFIP as it is today. We're going to talk a little bit about what is changing to the NFIP. And if we talk about what's changing, we want to understand what is not changing with the NFIP. There's quite a few things that are going to remain the same. And then we're going to evaluate the transition of current policies. I want to point out that this information is subject to change. The information presented here is correct as of the date of the presentation, and as we get new information or as anything changes, we will update you accordingly. To begin our discussion, we want to first talk about what Risk Rating 2.0 is all about. The NFIP has not been updated in quite a few years, and in developing the new rating methodology, FEMA has adopted industry best practices and current technology. This new program will deliver rates that reflect the true risk for each property. It will reflect more types of risks. It will provide rates that make sense for each structure, and all the different criteria that go into the rate will be automated. It's important to understand what the NFIP looks like today because it shows why FEMA is implementing Risk Rating 2.0, Equity in Action. As you see on your screen there, over 5 million policies are currently in force. This equates to over $1.3 trillion in coverage, and it provides flood protection to over 22,000 communities that participate in the program. This reflects why the NFIP needs to remain an important way for these communities to address increased flood risk, while also addressing the need for an improved and up-to-date methodology. The graph you see on the screen there paints a vivid picture as to why FEMA decided now is a good time to make the changes to the NFIP. As we look at the graph, we see that more was paid out in claims than was received. What we do know is that it will flood anywhere, regardless of the community or state that you live in. It can flood anywhere, but people have a hard time understanding that because they don't understand what their true risk is to their home or to their business. Let's begin to look at some of the details of this new rating methodology. Under the current rating methodology, the way the NFIP is today, policyholders on average see about an $8 premium increase per month. We know that policies are purchased by the year, but it was broken down on a monthly basis just to show you in a smaller increment. And that's about $8 increase per month. Now let's pay close attention to the bar graph under the new pricing methodology. 96% of all policyholders will either see a decrease or a $20 or less per month increase in their premiums. So basically, for those 66% of policyholders in the light blue section, they're on your screen, those policyholders are going to see an increase of what they typically would see now under the legacy methodology. So the question you may be asking is how and when is this going to happen? Here is what you need to know. FEMA is rolling out this new pricing methodology in 2 phases. To begin, we are going to talk about the first phase, which is for new business policies only. And the date for this is October 1st, 2021. This is for new business policies, but I want to talk about another group. What about the policies that renew between October 1st of this year and March 31st of 2022? FEMA is giving those policyholders an option to either renew under the legacy methodology, or they are able to renew under the new pricing methodology if it is beneficial to them. We're going to talk more about these 2 paths a bit later, but just so you know, if the Risk Rating 2.0 is beneficial to them, then of course they would want to renew under that, and they can. So later in this presentation, we're going to talk about the second phase, which is going to be renewals. Let's talk about some important dates that go along with the first phase. Starting in April to September, FEMA will share draft guidance documents with everyone. These will be provided in the resources available with this presentation. In September 2021, you may begin quoting policies with the effective date of October 1st, 2021. And at that time, FEMA will also release the final guidance documents. Now let's begin our discussion about the new pricing methodology. Let's begin our discussion today by talking about the legacy methodology, the NFIP today. See the variables on the left-hand side? These are the current legacy methodology variables. Now, of course, the NFIP looks at base flood elevation, lowest floor elevation, foundation type, but all of this information stems from the flood insurance rate map, or the FIRM. So for example, the FIRM is really the key driver of your client's flood insurance rate quote. However, when we start thinking about flood risk, let's just take a look at that FIRM that is right here on the screen. If you look at, say, an X zone, do you think they all represent an accurate flood risk? That is why we need to discuss all of the variables that will now be part of Risk Rating 2.0. Now let's look at them both side by side so we can really see what has changed. I want you to notice the expansion between the legacy methodology and the new methodology because there are some additional categories that are being captured, and under the new pricing methodology, we notice that there are also some additional data sources. One of the things that's new is the cost to rebuild. There are other rating variables like distance to flooding source, ground elevation, first floor height, and even prior claims that will now be considered under the new pricing methodology. As we phase into the new methodology, the flood insurance rate maps that are currently being used by insurance carriers and the agents will continue to serve as the foundation on which everything else builds upon. So if you are wondering if the flood insurance rate maps are going to be used in the future, the answer is yes. They will be used for floodplain management purposes as well as for lender requirements, but we will talk a little bit more about that later. A great example of additional data sources is something that's actually part of the NFIP that we're familiar with, and that is the Coastal Barrier Resources Act, or COBRA zones. That additional data source is added to the flood insurance rate map with data through the Fish and Wildlife Service. And that same layering process that we are going to describe is going to continue with Risk Rating 2.0. Now, there are some additional examples I'd like to mention, and one of those is the U.S. Army Corps of Engineers, and even things like the high water mark that we see within our local communities. These are added on top of the FIRM map, and it's also an excellent example of how everything is building right on top of the FIRM map. So why are these additional sources so important? Not only will they help the policyholder to understand their true risk, it is also going to result in a more accurate policy rating. How will this be done is the question. FEMA has integrated these data sets into the rating structure. When you, the agent, enter the application information into the system, it will automatically calculate your client's premium under this new pricing methodology. When it comes to aligning with the private industry, it is common practice to factor in the cost to rebuild. Let's discuss how this will be accomplished in the new methodology. You can see from this slide that this is a new rating element, and it will be determined by the risk rating engine. So what does that mean? It means that based on the information that you enter into the carrier's rating engine, it will automatically determine the replacement cost. As an insurance agent, this information will be very helpful to you, and the best part of it is that the system does all the work for you. However, I do need to point out that the engine will not automatically input the replacement cost value for a couple of categories. They are other residential, non-residential, or RCBAP policies. What will happen for these is that you will continue to use the current process to enter the information. So if you're using an appraisal or some other type of required documentation, the appraisal for these structures does need to include foundation cost. Under the new pricing methodology, the rating tables that are currently being used will no longer be used to determine the rate. The standard rating tables, like the ones we are used to seeing and working with, will no longer be used. Instead, the system will incorporate these variables. The rating variables will be used in an algorithm and will actually calculate a premium based on each and every one of those factors. What we want you to take away is that not only is the cost to rebuild a factor, but also additional factors such as the distance to flooding source, the flood type, building occupancy, construction type, foundation type, ground elevation, first floor height, the number of floors, and prior claims. Some of these items will need to be manually entered and others will be automatic. As stated earlier, the firms are still the foundation that everything else is built on. However, the flood zone and the base flood elevation will no longer be used for rating purposes. Also keep in mind, first floor height will be considered for all properties. Please remember that they will still be used by floodplain managers because buildings will still be required to be built in compliance with the NFIP. All right, let's continue to talk about these rating variables. Now we're going to talk about the distance to flooding source and the type of flooding. Currently, the NFIP looks at inland and coastal flooding, but we know that there are so many other types of flooding. The new pricing methodology will now include some of these other types. Let's take a look at that. We've got inland, storm surge, tsunami, coastal erosion, and Great Lakes flooding. And you see that other than inland and coastal, these other forms of flooding have never really been captured before. As an agent, when you enter the property information into the rating engine, it will automatically determine the flooding source as well as the flooding type that applies to that particular structure. Building occupancy is a key factor that determines which policy form to use, which specific rating factors apply, as well as the policy's maximum coverage limits and deductible options. I know that you are familiar with occupancy types under the current methodology, but what you see here is the new pricing methodology. It breaks things down a little bit further. The first one I want to mention is a single-family home, and that category is now being identified as single-family home, townhouse, or row house. And notice when we drop down to residential unit, that means it can be a unit in a condominium building or even an apartment unit. So these two occupancies were previously combined under one category, but now they have been separated. Construction type is something that you, as an agent, will select. It will not auto-populate. There are 3 choices for construction type. It will be frame, masonry, or other. On the screen here, you can read the descriptions for each one of these. You may be wondering, when you select other, the definition is right there, but let's discuss that. The first floor above ground level, whatever the construction type is what you would choose. So if it is another other than your wood frame walls or your masonry walls for the full first story, then you would select other. Frame or masonry will be your main options, but you can choose other if it is built out of anything else. Currently, there are 11 different building diagram numbers. FEMA is simplifying this and consolidating the foundation types down to 6 different types. These 6 are grouped into non-elevated or elevated. The first 3 are going to be your non-elevated foundations, and you see 2 of those right here on your screen. Number 1 is slab on grade. This is going to include the current EC diagram number 1A, 1B, and 3. The second picture you see on your screen there is basement. This is going to include the current EC diagram numbers 2A, 2B, and 4. On the screen here, the first image that you see is still one of our non-elevated foundations, and it is a crawl space. This includes the current elevation certificate diagram numbers 8 and 9. As we move forward, let's look at those elevated foundations. On your screen there, the second picture is your first elevated foundation. It is elevated without enclosure on post, pile, or pier. This includes the current EC diagram number 5. This is a building with no obstruction or enclosure beneath it. And if you have a hanging floor, this is going to be the foundation type that you choose. Now let's look at the last 2 foundation types. The first one you see on your screen there is elevated with enclosure on post, pile, or pier. This includes the current EC diagram number 6. These are elevated using posts, piles, or piers with an enclosure. And the last image you see on your screen there is elevated with enclosure, not post, pile, or pier. This includes the current EC diagram number 7. This is not using post, pile, or pier, so think about those solid foundation walls here. Let's define first floor height. First floor height is the height of the building's first floor above the adjacent grade. Think of the lowest adjacent grade, the lowest point of the ground that touches the structure. Now that sounds simple enough, but it is critical in understanding flood risk, and under Risk Rating 2.0, there are 2 ways on how first floor height can be determined. So before we go into the details about the 2 methods, know whatever method gives the most favorable rating for the policyholder is the option that will be used. The first method, method 1, is system generated. Look at this slide here. This is going to point out what first floor height is. Those arrows are pointing where you would measure the first floor height. So it's like the lowest floor height if you were using an elevation certificate. It'd be C2A and C2B for those of you that are familiar with elevation certificates. That is where you would find the information. With that in mind, let's start talking about the 2 methods of how to find first floor height. Method 1, system generated. The system is going to do all the work for you. You don't have to have an elevation certificate. When you enter the property information into the system, it's going to pull all the information for you. FEMA is going to determine this using informed assumptions, application information, and various data sets. Method 2, using the elevation certificate. So for method 2, how is FEMA going to measure it? So we have those dark blue arrows there. That is pointing to the lowest floor elevation. Now look at the light blue arrows there to the right. That shows the adjacent grade. So the first floor height is the difference between the light blue arrows and the dark blue arrows. Think about that because we are going to use that when we talk about method number 2, the good old elevation certificate. So under Risk Rating 2.0, you have all figured out now how that elevation certificate is optional for rating purposes. However, for floodplain management purposes in your local community, they may still require elevation certificates because they still have to make sure structures built within their special flood hazard areas are built to compliance. So they may still require elevation certificates. Since they are optional for rating purposes, you can still use them to determine first floor height. All you would do is look at what the lowest floor elevation is versus the lowest adjacent grade. As a side note, there is an option for the policyholder to fill out the elevation certificate using Section E and then sign it in Section F. Under the new pricing methodology, the number of floors will no longer include basements, crawl spaces, on-grade or subgrade, or enclosures. So for example, if you have a 2-story home with a crawl space or a basement, it would now be listed as having only 2 floors because it's excluding the basement or crawl space. Another example, if you have a building with a basement and 1 floor above ground, it's now rated as having 1 floor. Likewise, an elevated building with an enclosure and 1 additional floor above that is rated as having 1 floor. This is a question that is going to be asked on every single policy under Risk Rating 2.0. This is a big change. For condominium and apartment units, you will now see that the unit's floor will be determined by the actual floor on which it is located. So there is going to be 3 questions. Let me give you this example first. Let's say you have a condo unit on the 3rd floor of a 6-floor building. There will be 3 questions asked. The first, is this for a unit? Then, what floor is that unit on? And the 3rd question, how many floors are in the building? Your clients may have questions regarding claims. For example, they may ask, will my policy be affected if I submit a claim? Or they may ask, if I am buying a new property that has multiple claims, will the flood insurance cost more? Under the legacy method, the answer is typically no, but this will change under the new pricing methodology. When a policy is transitioned into the new pricing methodology, FEMA will not include the prior claims variable in the initial rate calculation. and this is going to apply to new business policies. The claim variable will go into effect at the next renewal once the property experiences the first loss under the new pricing methodology. So everyone is starting with a new claims history until the first loss after October 1st, 2021. For prior claims, FEMA will not include prior claims history in the initial rate calculation. With the NFIP, flood claims follow the property and not the policyholder. Only claims that fall under a 20-year rolling period will actually be considered, and FEMA also needs to account for severe repetitive loss properties. Before we talk about this further, I want to clarify what an excluded loss is. A couple of different types of losses will never be part of your claims variable calculation under the new pricing methodology. The first type is, of course, the increased cost of compliance claim payment. The second type includes the claims that are closed without payment, or what many of us call CWAP. That's it. All other paid claims are going to count toward the prior claims calculation. Let's look at a timeline to understand how and when the claims variable will apply. Now, I just stated that this is a 20-year rolling period, and that sounds pretty self-explanatory. But in this timeline, we are going to review the 20-year period. In this example, the policy is renewed in 2022, and the first claim occurs in 2024. So we need to roll back 20 years to 2004. And when we do, that's when we see that there were claims filed in 2007, another claim was filed in 2011, and both of these claims fall into that 20-year window. So for this example, how many claims do you think will be counted? The correct answer is 2, because under Risk Rating 2.0, remember, we will exclude one claim. So for that claim variable, the number of claims that are used to calculate the rating variable would be 2. A good way to remember this is the most recent claim is only counted as a trigger, and it triggers the prior claims rating variable, but one claim, that claim, is excluded. So we are going to use the same timeline, but this time looking at severe repetitive losses. This graphic represents a property that has severe repetitive losses. In this example, the policy has had multiple claims. So for this example, we're going to have a claim that was filed in 2024, and we need to look back 20 years. Again, the policy was purchased in 2003. There was a claim in 2005, 2008, 2011, and 2014. Risk rating went into effect in 2022. Now, in 2024, the claim was filed. That claim was claim number 5. How many of the claims do you think will be counted? The correct answer is 4, because that most recent loss triggered the prior claims rating variable, but one claim, that claim, is excluded. You may be wondering, what's different about severe repetitive loss property? First off, the severe repetitive loss policy will continue to pay the SRL surcharge. Second, once that initial claim is made, under the new pricing methodology, the SRL surcharge they have been receiving is going to be replaced by the prior claims rating variable. This change does not in any way impact the building's SRL designation. Let's move into the broader range of flood frequencies. What does flood frequency mean? Well, under the legacy methodology, the frequency is based on the 1% annual flood event, or what we know as the 100-year flood, because that is what it is commonly referred to as. Under the new methodology, the rating engine is going to incorporate catastrophe modeling. So that will include things like urban flooding, and that's going to be included in the flood frequency calculation. Now, obviously, these are going to expand the number of factors that are being considered, and it does create a broader, bigger range than just what was shown in our flood insurance rate maps with just the 1% annual chance event. Now, as to why this is more accurate, think about this example, urban flooding. We know the developments and draining issues can cause quite a bit of flooding. These models can take into consideration that as well. This will also ensure that the NFIP can better address future flooding events. Fees and surcharges will still be part of the NFIP policy. All of the current fees and surcharges will also apply under the new pricing methodology. They include reserve fund assessment, the HFIAA surcharge, the federal policy fee, and the probation surcharge if applicable. These fees and surcharges are going to apply to all new and renewed policies. Let's move on to talk about the statutory discounts and the mitigation credits. Let's begin with the new statutory discounts under the new pricing methodology because they do include pre-firm, newly mapped rated policies, and other. A quick reminder that pre-firm does mean the start of construction or substantial improvement was on or before December 31st of 1974 or before the effective date of the initial firm. And the other qualification for this discount is that the property does qualify as a primary residence, not commercial or designated SRL property. The second discount I also mentioned is newly mapped, available to buildings now in a special flood hazard area due to a map change where previously it was shown as a non-special flood hazard area. Unlike the current method that looks at prior losses for eligibility, under the new pricing methodology, this eligibility is going to be based on a map change from the non-special flood hazard area or the special flood hazard area, and the policy effective date is within 12 months of the effective firm revision date. For other, when you hear us refer to that, what we are really talking about is the AR or A99 zones and the emergency program policies. So except for the emergency program discount, all policies with these statutory discounts will gradually phase out through an annual glide path up until that policy reaches its full risk rate. So the discount for the emergency program will continue until the community joins the regular program status. Now, what I just stated is that these discounts will gradually phase out through the policy glide path. Again, what I mean by glide path is that policy will gradually increase each year until it reaches the full risk rate. One thing to note, if it's determined that the full risk rate for a policy is more favorable right at the start, then that glide path discount would no longer apply and the policy would just assume the full risk rate. It's important for me to state that any lapse in coverage could cause a policy to lose its glide path discount. Let's move on to the community rating system, or the CRS. Since flood zones are no longer going to play any role in the rating, the CRS discount will apply uniformly across the entire community. The discount is going to be a flat percentage rate, and it is going to be based on the CRS class. Let's give an example here. So let's review what I'm referring to and how it will change from the current legacy rating methodology to the new Risk Rating 2.0 pricing methodology. The CRS discount is a flat percentage that will be applied to all structures inside a community that participates in the CRS program. The big difference here is that it also applies to buildings that are outside of the special flood hazard area. The discount tier structure is not going to change, so classes 1 to 10 and that's associated percentage is going to be the same. Let's look at structure number 1. Under the current CRS structure, we see that this building is located inside the SFHA and it is also built to compliance. It currently receives a 30% discount, and we see that it will continue to get that 30% discount under the new pricing methodology. Let's go on to structure number 2, which is a standard rated policy, and this time it is located outside of the special flood hazard area. But the building is built to compliance, and under the current rating, it receives just a 10% discount. Now, with the new rating methodology, the building will go to a full 30% discount. For structure 3, we see a big difference. This time the building is outside of the SFHA, and currently it does not receive any discount at all under the CRS program, but it will get a 30% discount with the new pricing methodology. Building 4 is an example of a building that is not built in compliance, so currently it does not receive a discount, and under Risk Rating 2.0, it will not receive a discount either. Finally, structure number 5 is a building that is now eligible for the CRS discount where it previously has not been. Please note any policy that is on the glide path to the true risk premium will not be eligible until it gets to the full risk rate. It's time to move on to the machinery and equipment mitigation credits. This will apply a credit for the policy holders that have their machinery and equipment elevated above the first floor, regardless if the machinery and equipment is inside or outside of the building. For example, if you have a home that has a basement, you have to make sure that the machinery and equipment is located on the next higher floor. You as agents will certify that the machinery and equipment meets this criteria by answering a yes or no question on the application. The credit is 5% and it is calculated prior to any fees or surcharges. Now let's talk about flood vents and how property owners can qualify for this mitigation credit. The rating engine will apply a discount to the policy for a building in the flood zone with proper openings in the enclosure. So to receive credit for these proper openings, all enclosures that are below the elevated floor must meet the following criteria. There must be a minimum of 2 vents on at least 2 exterior walls. The total square footage of venting must be equal to the total square footage of the enclosure. It also needs to be within 12 inches of the adjacent grade inside or outside. For the agents that are familiar with the current flood vent discount, only applying to those structures that are located in a flood zone A, as it states on the slide, proper venting for any elevated building with an enclosure in any flood zone will be available for this new rating methodology. To apply the discount, the agent will simply answer several questions on the application about those flood vents in order to obtain the credit for the client. Finally, let's talk about flood proofing. Generally, it's been applied for non-residential buildings, and there are some residential basements in those approved communities. It can be an alternative to elevating the building at or above the base flood elevation while still providing a more beneficial policy rating. But it is a little different under the new pricing in that now a mitigation credit for those who qualify. Once again, on the application, the agent will answer the questions pertaining to flood proofing and submit all of the required documentation. For example, if it is a residential basement in an approved community, that insurer would then certify the eligibility. For those non-residential buildings, the carrier will submit all of the required documentation to FEMA, and then FEMA will determine the eligibility for the discount. And if that insured is eligible, FEMA will coordinate with the insurer to apply the discount to a policy. That documentation for non-residential floodproofing is the same as the current documentation. Well, we've covered a lot of ground already, but now we need to talk about what is going away. Grandfathering under the new pricing methodology will no longer apply. Why? Well, remember, base flood elevations and flood zones will no longer be used in the rating of a flood policy. So what happens to the policyholders who have a grandfathered policy? Let's take a moment and say you're walking down a path. You come to a fork in the road. That's what's happening with a grandfathered policy. At that fork in the road, there is the legacy pricing methodology and a new pricing methodology premium. So which path do you take? When you come to the fork in the road, the system is going to run the policy through both. Which one is more beneficial? Is their true risk premium more or less expensive than what they are paying? If it's less expensive, they will move directly to that premium. But if it's more, they will go down the other path and pay their current premium subject to annual statutory increases. This will set them on that glide path. To finish up this section, let's talk about retired policy types and rating methods. The preferred risk policies are the first that we're going to talk about. A PRP policy will no longer be offered. With the change to a risk-based rating and the move away from the flood zone for rating, the PRP policy will no longer be continued. These customers will move on the glide path unless the new rate is more beneficial. At renewal of a current PRP policy to the risk rating 2.0, if the property's full risk premium is lower, that premium will be billed at renewal. From then forward, the policy will be under the glide path for full risk rate. If the full risk rate is higher for any policy, including PRP, they will be on a glide path. If the full risk rate is lower, their premium will go down at the next renewal. The PRP was a set amount. Now, since it's not being offered, the insured can set their own coverage amount. So keep in mind, a former PRP policy can lose its glide path if the policy lapses. Now let's talk about the MPPP policies. This won't have a big impact and will only affect about 100 policies. Many lenders started purchasing regular NFIP policies and not using the MPPP. Finally, submit for rate. I know that I'm going to get a lot of tears on this one, but because the rating system is now an algorithm, FEMA has yet to find a policy that can't be rated, negating the need for this special rating process. So what is not changing? I'm going to read through this list and then we're going to discuss each one. The first thing that's on the list is that mandatory purchase requirement, floodplain management, statutory caps on annual individual rate increases, building contents eligibility and increased cost of compliance, the underwriting forms, and the assignment of a policy to a new building owner. Mandatory purchase requirements will still exist, and the lender will still require insurance for those properties located in a special flood hazard area. You may be thinking, I thought we were not using zones with risk rating 2.0. Yes, not for rating, but you are going to find that floodplain managers and lenders, they are still going to be looking at those flood insurance rate maps to make sure they remain in compliance, whether it's with their regulators or with FEMA, if you are a local community. So they will still be using the firms. The waiting periods are also staying the same. The standard 30-day wait will still apply unless the policy is in conjunction with a loan. So that's not changing. Floodplain management is not changing. And in case some of you do not know, whenever a local community joins the National Flood Insurance Program, they agree to adopt and enforce a set of floodplain management regulations. In addition, LOMAs, the letter of map amendments, and LOMERS, the letter of map revisions, are still going to exist. Floodplain administrators, as well as business or homeowners, will still use elevation certificates and flood insurance rate maps to apply for those. Statutory caps, the 18% statutory cap on annual individual rate increases is not changing. Now let's talk about building and content eligibility. Building and content maximum coverage limits are not changing. However, the coverage amounts will no longer be in the $100 increments, but will instead be sold in the $1,000 increments. Increased cost of compliance will still remain at the max $30,000, and how to qualify for ICC still remains the same. One slight change is the current methodology. ICC is a set premium. Now it is going to be a small percentage of the building and contents premium. So it is going to be 1.9% of the building and content premium. Underwriting forms are not changing in the way that they are used, but they are being updated. What I am referring to here is the application, general change endorsement, and the cancellation forms. The policy forms, the dwelling, general property, and RCBAP are not changing at this time. They will remain as they are. Let's talk about the assignment of a policy to a new building owner. The assignment of a policy to a new building owner will remain under Risk Rating 2.0. Say you are selling a house. The buyer will still be able to assume the seller's NFIP policy. The same rules apply as before. The only slight difference is the seller can endorse the policy prior or at loan closing, but the buyer has up to 30 days past closing to submit that endorsement form to the carrier. This brings us to our final section, the transition of current policies. Remember, FEMA is rolling out this new pricing methodology in 2 phases. Phase 1 was October the 1st. That was for new business. But now we're going to talk about phase 2, and that is for our existing policies. All existing NFIP policies renewing on or after April 1st, 2022 will renew under the new Risk Rating 2.0 rating methodology into the property glide path or the appropriate full risk rate. For policies renewing between October 1st, 2021 and March 31st, 2022, FEMA is giving the policyholders the option to renew under the legacy methodology or the new Risk Rating 2.0 methodology. Existing policyholders will be able to transition over to the new pricing methodology if it's beneficial to the policyholder. Now let's talk about the renewal bills. Premium decreases will go into effect at renewal. Since we know that PRPs and newly mapped policies will no longer be around, those same policyholders are able to make changes that they were unable to make before. They can change their deductibles, they can change their coverage amounts without being locked into these set packages for building and content coverage. It is important to note any policy under the new pricing methodology is only going to have 30 days to pay that policy premium. If that policy expires and it is not paid in that grace period, the policy will lapse, and that means that the agent would then have to write a new policy under the new Risk Rating 2.0. So that policyholder could lose those statutory discounts and be subject to the property's true full risk rate. So to summarize, today we discussed the legacy methodology. We went through Risk Rating 2.0, Equity in Action. We talked about what's changing and what's not changing, and we talked about the transition of policies. With Risk Rating 2.0, there are a number of resources that you can refer to. You'll see most of those resources listed here on the screen, and you can also refer to the Risk Rating 2.0 page on National Flood Services website.